What's up, everyone? Welcome back to the episode. We've got Bill, the lender, on here to talk all questions and all answers regarding lending. He's a knowledgeable lender, and it's actually Jenny's go-to lender. Jenny, how are you?
I'm doing great. How about yourself?
Doing very good. So the title, Bill the Lender. Who is Bill the Lender?
Bill the lender. So we have Bill Rodriguez with us.
He has a last name,
yes,
actually.
He does have a last
Okay.
name. And he works with Cornerstone Home Lending, and he's been an amazing person to work with, just both personally, like he's helped us refinance our personal home, many rental properties we have with him, and then he's been just completely invaluable to a lot of our clients that especially down in Colorado Springs. Everyone loves working with Bill, so
Appreciate that.
He's just been great to have on our team for sure.
And I don't know, it's the clients like working with him, so the agents,
Yes.
because us as agents like lenders that can get the job done and help us get to the finish line.
Exactly.
And your name comes up as one of the great lenders to work with. So I
Love to hear that.
Yeah, so
That's what it's all about.
We appreciate, so thank you.
Yeah.
Happy to be here.
Yeah. So I mean, Bill, just give us a quick rundown on just your background and just how you got into lending. Just a quick bio about Bill.
So actually came to Colorado in '99 and started out in the telecom industry because that's where my father was. I sort of start out. He helped me get a job in that industry, and that was '99 was like .com bubble bursting, and it was kind of stressful to be in corporate America during that time, and that industry just went through so many waves of management changes and consolidation and these types of things. And I kind of looked at getting out of that because I literally watched my father retire from that industry, but it was an early retirement. It was a pat on the back and a go watch, and ushered out the door. And I was looking for something I was good with numbers, and I was sort of looking for something to when the blue chips were down, what could I get into that was fairly stable? And obviously, as you guys know, real estate sort of buoyed the market back then, and it continues to do so now. And that's what kind of got me into it. And so I started as a broker. I've been now in the industry, made it a career the last 17 years. So it's just been a wild ride. Through 2008 and so many changes and ups and downs, and, going from being a broker to now being licensed. I mean, there's just been a lot of changes.
So when you talk about being a broker going licensed, what do you mean?
So, I mean,
A mortgage
we were
broker.
we were
Okay.
unregulated before, 2008 happened. And then we all had to get licensed and
Oh, I didn't
bonded
know
and
that.
I didn't realize that
Yeah.
either.
Oh, yeah.
Yeah, I was not in real estate back then.
Yeah, back, I mean, it was the wild, wild west, and then after 2008, we all had to get licensed. And, there was, if you were a broker, you were kind of thinking, well, do I go to the banks? Do I, if you can't beat them, join them type of a deal? Because, as a broker, you kind of shied away from U.S. banks and the Wells Fargos and the big chases and stuff.
Yeah.
Because you didn't have the flexibility. But I think during that time, you kind of considered that because they had dealt with the FDIC. So as a broker, since we had never had to be regulated, we didn't quite know where to go. So I took a small stint in community banking there for a while, thinking that was going to be the be all end all, and then just ended up back at mortgage banking because do one thing, do it well.
All right. So, Jen, I know you got a list of questions that you've kind of aggregated from our clients. So
Yeah.
you take the lead.
Yeah, we'll just kind of dig in and we'll see where it takes us.
All right, let's do it.
So you're an investor yourself.
Yeah.
So that is definitely a huge asset to clients who work with you, because you understand kind of, marrying up the investment world with what they're looking for. And then, of course, being on top of regulations and all that good stuff. So can you maybe describe a couple programs that I know that you've gotten some house hackers into, and then, we've had some people that did, larger multifamilies. Can you just kind of maybe talk about some of the highlights that you've seen over the last couple months with our clients?
Sure. I mean, I think there's a distinct advantage. I mean, if you're sort of entering the market as a new investor, if you're willing to live in a property, for 2 years or more, you're, escaping cap gain. On multifamily, you're putting less down. You can, sort of weigh in and schedule your updates to the property over a longer period of time. I mean, those are the real big ones in terms of helping people sort of get into places for less. Otherwise, it's just really being competitive in the market and offering, great rates and flexible terms. I mean, you can put on an investment, single family, 15% down. I think one of the advantages that we have is we really help people sort of understand the cost benefit. So if you want to put less down, you're going to pay higher rates and fees. How does that affect your ROI? And we help them sort of take a look at that, compare all the programs side by side, and see what makes the most sense. But it's really a strategy game at that point. But yeah, I mean, I think there's stuff out there. I mean, there was a little bit of a market shift this year where we saw rates sort of be all over the place, but we're still remaining competitive.
Great.
So I want to actually, I'm going to pick your brain on this because this is one of my favorite topics. I like to look at myself, and we talk with clients. You alluded to, hey, trade-offs. You put less down, less money out of pocket, but usually, might be more points and higher fees.
Right.
Give everyone like a general overview about that, and what is your personal preference? You more like, hey, max out leverage and pay a little higher fees, or kind of what's your personal opinion and how you attack it?
That's hard to say because there's just a lot happening in the markets right now where, people's appetite, depending upon, some of the changes with the FHFA, people getting penalized for putting less down. It depends on where you are at in the day. You kind of just have to sort of price it out in the market, see where rates are at. So if you, and by the way, if you've got the cash, I like 20 to 25% because it's, 25% down, you're getting sweet rates, and we're looking at buy and hold. So longer term, you're going to make more money. But if you're just trying to get into the game and it still makes sense, then you may look at less cash. I think everybody's situation is unique, and that's where we kind of come in and sort of personalize it, really take a look at what's needed for them.
Awesome. Yeah, I agree. I've found that when I first started investing, I was more on the 15% down side of things, and now I'm getting to more, I'd rather just put 25%. Just
I mean, if you've got the cash,
the rate,
you can find the cash. I think over the long term, it makes more sense.
Well, for the record, I'm still in the 15% camp.
Yeah.
Yeah.
Oh yeah. Yeah.
There you go.
Yeah. But that's the thing. It's each its own. Yeah. This is why it's so great to have lending partners that, they know the investing aim and sit down. Hey, great. There is no right or wrong answer.
Yep.
Right.
What is your goal? What's your risk tolerance?
Level?
What's this? Well, all this stuff, and it's always unique.
Right.
And that's great.
Yeah. And then something that Chris and I were talking about recently was always find the lenders first, the deal second. Don't find the deal, then find the lender. So, so it was a topic of conversation that we had. So something that I really appreciate with you as a lender is that, and to be frank, is that you've never dropped the ball on any of our transactions within our team. So thank you for that. But then I think that speaks a lot to your process as well. So maybe you could kind of describe a little bit about how you guys go about that.
Yeah. So I think we're really unique in the sense that we're trying to get every client who's willing to give us all their documentation up front, pre-approved within 72 hours and ready to close within 10 days. So that's our 10-day ready program. And that's really powerful in a market like this because it helps our clients compete same as cash. So we're removing all of the finance contingencies except for your basic big three. So, that's going to be your inspection issues, related issues, appraisal related issues, and any defects in title. So, it gives people a lot more confidence knowing that all the legwork, any problems have been identified up front, they've been handled. And then when we go as the local lender calling the listing agent, we just have just a ton of confidence to sell these guys as hard as we can and then share about our 10-day ready program.
So talk a little bit more. What is the 10-day ready program like? Like, go a little more context on there.
Yeah.
And then compare it to, because I think I know what it is, but I don't know the details of it, so I don't want to assume.
Yeah.
So what it is and how it kind of compares to normal industry standards.
So, I'm seeing 30-day close is your standard contract.
Yep.
A fast close in this market, you hear people saying 20 days was fast. 10 days is a lot faster. And the only reason that we're doing 10 is that, there's a regulatory rule that the customer needs at least 7 days to review the documents, right, for TRID. So the 10 days is just for literally turning an appraisal within 24 to 48 hours, which is also unheard of in this market. And then getting somebody all the way through the process and being reviewed by an underwriter so that you can literally close. Now, recognizing that you're talking about a standard, most times you're going to have somebody living in the property. So, for your audience who are investors, if it's a vacant property, this gives you a pretty distinct advantage because we can close in 10 days.
So your 10-day ready program, you're doing a more thorough pre-approval up front as part of it, or is that just your standard pre-approval? Then you have the option to just close fast?
No, they're already through underwriting.
Okay, so
they're ready to go.
Okay,
literally close from contract, the day the contract gets accepted, to close in 10 days.
And so average, scenarios is they're not going through underwriting before they go under contract. Is that what you're saying? Like the person?
So as part of the logistics of the process, in order to be qualified for the 10-day ready program, you really have to have sort of buy-in. So it's part of the client experience. You really have to have buy-in with the client to say, okay, we're going to help you get a distinct advantage in this market. In order to do that, we have to have this list of documentation, right? You've had the take application. They provide that list. From the time that they provide that list, within 72 hours of that list, we've got them approved for a loan. And then once you find a house, then 10 days from there.
Okay. I got a couple really nuanced questions on there.
All right, let's do it.
So I'm assuming you're like ordering a rushed appraisal?
Yeah.
Okay.
Yeah. So
is that extra for the client then?
So yeah, we prep the client for that. So Cornerstone has its own appraisal management company inside of Cornerstone, so it gives us that level of control.
Okay.
Right. So we have a list of approved appraisers, and then we've sort of tiered the list. And then if they see it come through, then they know to turn it within 24 to 48 hours.
Okay. So they give the heads up.
So, but that's, you're gonna charge a premium.
Oh yeah. Well, I mean, you want it done
sense.
quickly, you pay for it. Oh, yeah.
Right. And it's easy to sell in this market.
Yeah.
Because any advantage that you can give is a distinct advantage for the client, and they're usually on board.
Does that apply to VA loans? Because I think VA appraisals are a different.
That's a different
thing.
animal.
Okay.
Yeah. So like your down payment assistance loans, VA, because it's a separate process ordered by the VA, we're not going to be able to go 10
And VA has their own appraisals, right? Mm-hmm. Okay. So this is really more for FHA conventional, the standard
Correct.
Loan product. Okay, perfect.
Yeah.
Yeah, and to be clear, that the 10-day also applies to multifamilies, because I know I had a client that, his advantage.
We were 14 days on that one.
I think we're 17.
Yeah.
It was hard from a due diligence standpoint, but you guys are on it.
Yeah.
So that was what helped him win the contract. He didn't have the highest offer.
Right.
But because of the lending confidence, that's what the listing agent told me. So
yeah, we get that a lot, actually.
Yeah. And the seller wanted it gone because he had a 1031 ladder. So yeah, it was fast and furious, but it all came together.
Not afraid.
Yeah.
Not afraid. Not afraid at all.
The other thing you mentioned there, Bill, you made a comment a few minutes ago that you talk to people and you're coming as a local lender versus a big national lender. Mm-hmm. What's that dynamic like when someone's talking to a listing agent who's selling, why is the listing agent and the seller more interested in talking to, Bill, the local lender, versus, Tom from Wells Fargo or whatever?
Well, I think it's, without bashing competition, I think it really is confidence. If they have an experience, we have a great brand here in Colorado. Just Cornerstone, pretty much Longmont North, we have like a 73% market penetration because we have so many.
Holy smokes,
it's
really?
Huge.
Wow.
Huge. Because if you're not bumping into Cornerstone Retail, then you're bumping into one of our other brands, which is our joint ventures with Oakwood Homes, which is Nest Home Lending.
Okay.
The Group, which is a huge,
I know, yeah.
Everybody knows the Group. They're one of our biggest joint ventures with the Group Mortgage. That's us too. So people are just bumping into us everywhere. And they may or may not know it, but if they've had an experience working with Cornerstone, and you get a call and you say, hey, listen, we're going to run through the gamut. And you can tell a good listing agent, they know what questions to ask. And as long as you're saying, hey, look, this has already been through underwriting. We've already verified the assets. We've checked the credit. We're ready to roll.
Yeah.
That's, I think, the thing that makes the difference.
Answer my question.
Yeah. Yeah. So I guess we can shift gears a little bit to kind of topical questions, if that works for you.
All right, let's do it.
So a couple months ago, FHFA came down with a restriction on investment loans. Can you explain to everyone what that was, what it means to investors, kind of,
Sure. Yeah. I mean, so I did a lot of research out there. There's a lot of misinformation in terms of what this actually means. It when you read through it on the web, it sounds like a cap almost. Like you get to the 7% and Fannie and Freddie are just going to stop accepting loans, which is just not true. But what it does mean, I think long term, even though we haven't seen this sort of in the marketplace yet, is that there's going to be higher rates and fees to investors. So, mortgage companies, as they deliver loans, if they're over that 7% in terms of what they deliver, including second homes, which I think was a surprise to some folks, if you're over that 7%, then there's going to be like this adverse market fee we saw with refinances that the CFPB just repealed. It's going to be something like that. There's going to be an additional, charge, and it's going to, maybe a higher rate. It may be higher fees for the same rate.
So I just want to clarify. So this is from the FHFA rules change, and you mentioned 7% because they went down from, they would only take a certain amount of investment loans and second home loans.
It was in the teens. I don't remember exactly what it was, but they almost halved it.
Yeah. So I think it was like around 14. They were up to 7 from.
Right.
Okay. And then from there, so you're saying it's not 7% just across the markets. It's 7% from like Cornerstone, 7% from Jenny Lending, 7%, or how does?
So if you're a mortgage lender and you deliver over 7% of your portfolio to the secondary market, then you're going to have to factor in additional costs to deliver those loans. And you know what happens anytime there's additional cost.
Well, this gets passed along.
That's exactly right. Anytime these changes get made, they get passed along to the consumer.
Well, that's the way the world works.
Right.
So have you seen, has this happened, I think, in March or April is when they...
Right, that's when they announced it.
Okay. Yeah. From like a day-to-day impact, like, hey, one of our clients goes over, let's say they bought a place in February, now they're buying a place in June, before and after this announcement. Same property, same down payment terms, 25% down payment on a single family home or whatever it is. What's the difference in rate, interest rate, and or difference in like points up front?
It's hard to say because, one of the things that you guys from April to June, I don't know if you guys noticed, but rates were all over the place depending upon the lender. And to get specific, you have to get specific to the lender, to get specific to how much they're delivering as part of their pool, to get specific to their cost of doing business. So it's really hard to say.
Can we get specific to Cornerstone? Or is that a little too? Is that?
Yeah,
I know you can't like say rates and stuff. I know there's like rules around that.
Yeah. Okay. I mean, that's a harder question to ask.
Yeah.
I can tell you that now that things have calmed down, anytime you rile the markets, there's going to be a reaction. Things are going to go crazy. We like stability because it factors into the cost of doing business.
Oh yeah.
So now that things have sort of calmed down, and we've changed some leadership with the CFPB. Mark Calabria's gone. They're talking about doing now a bipartisan committee to run the CFPB, so there are a lot of these changes have sort of settled down a bit, and we're seeing things calm down in terms of cost.
Okay.
Yeah. So I'll leave it there.
Okay. So obviously that's something for people to be aware of.
Yeah.
I mean, but when I bought my property with other clients, like it's nothing significant that it no longer made sense to buy the property. It cost a few more dollars. Mm-hmm. But you're saying even from that initial like kind of knee-jerk reaction, the market overall has calmed down in terms of like points and fees.
Yeah, I mean, my point being is that wasn't possible, 2 months ago.
Yeah.
I mean, you were comfortably, in the low fours.
Yes. Okay, great. Thank you.
Yeah, that's very helpful and just kind of interesting to
Yeah.
see the, what was thought to be an impact versus actuality. So that was really good context.
So the punchline is it's not as a big deal as everyone thought it was 5 months ago. Is that
the
simple message I can take away?
Yeah, and
Okay.
now that we're starting to see sort of a regime change, I mean, hopefully it becomes more policy friendly. I mean, we're already starting to see some repeals of the adverse market refinance fee as an example, because that made the industry pretty hot and heavy, angry.
Yeah, I didn't know they were charging like a 0.5 point premium, right?
Right.
So they're repealing that now?
That's gone.
Oh, I did not know that.
Yeah.
Okay.
Yeah.
When did that go?
Last month.
Oh, all right. Thank you.
Yeah. Yeah.
So I know we were talking a little bit before we started recording about the impact of forbearance.
Mm-hmm.
And it's a really interesting kind of spillover effect or non-effect, really, is kind of the summary of that. But I was wondering if you could maybe dig into that a little bit.
Yeah, I certainly can. I think that the forbearance numbers were really, really scary during the pandemic. They got really high. And there was just a lot of concern. I think what we're seeing now over time is that those numbers have come down pretty significantly. And we actually have some stuff that we can look at, Colorado specific.
Should I start pulling that up?
Yeah, if you want.
Okay.
Yeah,
no, I thought this was a phenomenal resource.
So that is, there you go. So you can plug in the state there. And
so we got Colorado selected.
Yeah, so one of the big markers for whether or not a homeowner may be in trouble of continuing to make their payments is this 30 to 89 days delinquent sort of stat there. And you can see that in comparison from January of 2008, which is sort of our last big, issue, 2020, we're down to less than 1% in Colorado. So one of the other things that I took a look at is how many, units or homes we have in Colorado. It's 2.4 million and some change. So if 1% of that came to the market, let's say all 1% came to the market. I mean, when you look at the next slide, which is the
So you threw a lot of numbers here. So there's 2.4 million homes in Colorado. 1% of 2.4 million is 24 grand.
Yeah,
or I'm sorry, 24,000
homes.
24,000.
Then you look at, what we're currently looking at, even being down 5.9%, you're still looking at what? So 14,000 homes, so less than 2 months of inventory hitting the market if they all hit the market. So that's not even a dent. Like, it's not going to undercut. I think a lot of people are like, should I buy now? Can we sustain
they're waiting for the
this?
wave of foreclosures.
Exactly. And they're all looking at these numbers and going, when's it going to happen? And you're just not seeing it.
Yeah.
Even Jenny Mae, they were at 10%, and that's FHA and VA. and now they're down to like 6% nationally. So even
in terms of delinquency. Okay.
So now in terms of forbearance, we're not going into delinquency rates. Those I haven't actually pulled those stats. We might want to take a look at that.
Sorry, what's the difference?
So forbearance is they deferred the payments.
Oh, right. Okay. Yep.
Right. Delinquency is they've gone through their forbearance period. Now they're still not making payments.
Okay.
So these stats, though, are they capturing people that have a negative equity situation opposed to someone who could just, if they're in a sticky situation, they could sell their home and still walk away?
That's harder to do.
Okay.
I mean, the one thing that I will say in terms of the stats that I've seen is that we have more equity than ever. It's like on average nationally, like 30% equity. So the majority of the people that are in forbearance, they have some room to tack it on the back end and get out of it or do a mod or something, which is why I think these numbers are so much lower than what people thought.
Interesting.
But it's not the catastrophic undercut of the market that I think people are waiting for.
Yeah.
And that's what I think the message is there.
Because even if, like I said, if that whole wave hit, I mean, okay, that's what, 2 months we said of inventory Colorado wide? I mean, 6 months of inventory is like a balanced market.
It's a balanced market. And that would probably include FHA and VA. That would be both hitting the market.
The thing which fascinates me, you mentioned like negative equity. Even someone bought a 0% down VA last year. A year and a half later, forbearance is gone, they're delinquent. Their house has probably gone up, what, conservatively 5 to 15%, maybe a little higher. Like you can still sell it, pay fees,
walk away,
and walk with a few
little
bucks.
bit. Yeah.
Exactly.
Yeah. So that's the one thing I don't see the wave of foreclosures based on the data and just how crazy the market's been.
And it's just what Colorado Springs is at like 2 weeks of inventory. So
high, huh?
Yeah, 2 weeks plus 2 months. I mean, that's not even enough to really change pricing, you know? So yeah, it's pretty interesting.
I have a really random question for you, Bill, and you can defer this, or I don't know if it's appropriate or not, but does Cornerstone, do they do their own like loan servicing?
So yes. So actually, I can't actually talk about this.
Okay.
And we're actually really excited because Cornerstone, as of January, just announced that they, so we service our own loans, but we have sub-servicers like Dover Mule, and those are some of the biggest ones.
Explain servicing first.
So you're contracting to collect payments, but you still have a note holder, which would be like Cornerstone. But the administrative piece is contracted out. Okay. Cornerstone has actually announced that come January, we're going to do all of our own servicing. And we're building a servicing facility in Denver. It's going to be like 200 jobs coming to Denver.
Wow. Nice.
Yeah.
Cool.
Okay.
So it's really exciting.
And so I don't know if you know these stats, but I remember it was last year when all the forbearance stuff came out. I remember, a lot of loan servicers, like there was fear that they were the ones going to get pinched. Like, hey, the loan servicer still has to pay the investor who's holding the note, but if the borrower, the homeowner, doesn't have to pay, did you guys see any like wonkiness or any like stats that were different or similar to like what we're talking about here in terms of like just servicing loans? Or
that was we actually did during the COVID times, we did a whole presentation just talking about helping people understand the servicing platforms and why things dry up. Like, because there's so many servicers that they're purchasing a servicing platform for a fixed percentage, but if those folks aren't making their payments, then that gets devalued.
Yep.
And so these servicers were having margin calls on their companies, and they have to raise capital overnight. It was a nightmare because, like you're saying, the government's decided that people don't have to make their mortgage payment to keep them in their homes, which is a good idea, but the note holder still has to get paid. And it's the servicer's responsibility to continue to make those payments. So it's still created quite the tumult in that side of the industry for sure.
Okay. But the market's it's
why we're bringing
it's balanced down or calmed down enough.
It's starting to calm down. Now, them extending the foreclosure moratorium and things and extending that forbearance till the 30th of September doesn't necessarily help. But I haven't heard as much about that side of the market.
You're doing good with our curveballs, Bill. I like this.
So, and then of course the $1 million question, inflation.
Yeah.
So
The arch enemy of interest rates.
yeah,
It's the kryptonite.
can you give everyone just context as to what would happen in that case?
Well, which part?
So I guess we'll start with the happy part if someone already has a loan.
Yeah.
And then we'll go into kind of the change in that.
So, obviously with the market downturn, there's an opportunity to keep rates low, keep things moving, keep people buying homes, because that industry has traditionally kept the markets afloat. Monetary policy, which I can't really talk too much about in terms of the Federal Reserve, but just they're stepping in. There's so much monetary massaging, we'll call it, that really rates should be a lot higher than they are. And then you've got now the fact that we're, trying to stimulate the economy. We're sort of printing money to put it back in the hands of the street. There's, a labor shortage, which is inflationary. There's gas prices, which are inflationary. So there's a lot of inflationary pressures right now that, we're not really seeing because there's so much market manipulation. So it's kind of hard to really gauge where we should be, because where we should be is certainly a lot higher than we are.
So for those of us that have primaries in the twos, which I would say at this point a lot of people have done.
Yeah.
Is that free money? Is it, is the loan being, I guess, a lesser burden with each passing year in terms of?
I mean, when you consider where you could get money and where you can get it now, I mean, there is an element of like, when are you what are going to be the circumstances where this is ever going to occur again? Yeah. I mean, I've been saying that for years, though.
Do you see any scenarios on interest rates dropping lower than? I mean, I think last year was like the all-time low, maybe. Like, right now, it's still very, very low. Like, do you see them dropping like significantly low? Because I've heard we could go negative, like Denmark or parts of Europe did. Like, do you see any realistic scenarios on that happening?
I do see rates going lower. I don't see them going negative because. And again, I can't comment too much on that because it's a little area out of my expertise. But I would say that the folks, MBS Highway is some of the folks that I listen to, Barry Habib, some of those guys really think that once all of the inflationary pressures of all of the stimulus and everything work its way through the economy, we can get people coming back to work and wage pressure goes down and these types of things, that we may see lower rates coming. That
really?
Yeah. I mean, also, I think a lot of people are sort of adjusting their outlooks to say, if there's a recession around the corner, which there may be, typically rates trend lower during those times. So will they ever get down to as low as they were? I mean, I don't know, man. I mean, we're sort of in uncharted territory. It's really, really hard to say.
Yeah.
Yeah, it's just interesting to me. I mean, I can't even wrap my head around it, I guess, how complicated it is. But it's just, you figure rental properties, our clients are getting them in the threes. Are they getting a return better than 3? Absolutely. Mm-hmm. So, to be able to lock in a 30-year fixed and put that in an appreciating asset with, obviously costs are going to go up too, but so is the income side of things. It's just really interesting to think about that from a long-term perspective as to like how less burdensome today's interest rates will be for us in the future.
Right. And that eventually someday rates will rise.
Yep.
You'll eventually be right.
Eventually.
So I'm going to change gears here. I got a couple other questions for you. Since we started talking some investment loans here, we get this a lot, Jenny. LLC versus personal name when it comes to investment loans. I know it gets into a weird area with lending, but talk about that, just how that works. And we get that question. I want to hear your answer to that question as well.
Well, I mean, when you're looking at traditional financing from Fannie or Freddie, they just don't allow it. That's the one thing.
It has to be in your personal name.
It has to be in your personal name. They don't make business loans as considered a commercial loan from their standpoint. From that standpoint, too, if you've used one of those loans and then maybe you've decided to transfer it into a business name, you need to make sure that before you do that you review the terms of your loan, because there could be considered a sale to the business, and there is a due on sale clause, and they could call that due.
Have you seen over your, almost 20 years of experience, have you seen many instances where that's triggered the due on sale clause?
I haven't personally, but I'm sure there are.
But you're also probably out of that,
right?
Kind of that part of the equation, right?
Yeah.
I imagine if rates started to rise again, that could be a worry to some, right? Because
or their higher default rates. I think, people will likely more default on their rentals before they lose their primary.
If I had to
need a place to live.
Yeah, if I had to pick between my primary and paying my rental, my primary is going to win every month over my rental, because that's where my family is.
Right.
Yeah.
So that's where you may get into trouble.
Interesting.
So what, this actually circles back around to the, what do you call it? You had your 10-day, your 10-day ready program. And Jenny's quote was good. I loved it. Find a lender first, the deal second. So when someone comes to you for lending, which is usually kind of at the bottom of what people's favorite thing to do on their to-do list is.
Oh, come on.
Nothing personal against you, Bill.
Yeah.
But what can people do to be be a good candidate for lending and just be prepared and just be efficient and get the job done and minimize curveballs and headaches for everyone downstream?
Well, it really does. In this market, you have to sort of vet everything up front. I think it's critical for you to talk to a good local lender that has a great reputation, that can get the job done, and then give you the level of comfort and the expertise to sort of guide you on what strategy, help you know how much you qualify for. And then, if you're specifically, if you're self-employed, what people don't realize is that CPAs and lenders are actually diametrically opposed on either side of sort of the financial service related piece of this, where CPAs are constantly trying to maximize your tax benefits and write-offs and these types of things, and a mortgage loan officer is trying to squeeze every dime they can out of your tax return to help you qualify for whatever it is that you're trying to do. So, thinking of it more like a panel of financial, advisors to sort of consult together and talk about, okay, so how do we maximize the amount of write-offs so that we're not paying more than we need to, but we have what we need to be able to execute on what we're trying to do. So we actually recommend for self-employed borrowers, if you're planning on making a move within the next 12 to 24 months, that you actually get us engaged early, so that you can either scale up your income so you're paying less taxes over a period of time, or we can help you come down to the penny of how much you need to pay, and you can prepare for that in the budgeting of your business and still do what you want. And then the other side is, financial planners, right? A lot of times, these borrowers are sophisticated. They've got money coming from a multitude of sources. Sometimes it's qualified funds. Sometimes it's liquid funds. Sometimes it's equity from other properties. And the documentation around sourcing funds to close is like the number one place where it just drives people crazy. Because depending upon what they've got flowing into their business account or whatever, and if it's a certain percentage over their income, we've got to source all those deposits. So if you're working with the financial planner and you can schedule that one transfer even if it's from multiple accounts, now I've got all the sourcing documentation. It streamlines the process and makes it less of a headache for everybody involved.
You said some great stuff in there, especially for like self-employed people, because we have a lot of people, they get tripped up by that, or they're making transition from their W-2 now into more like an investor or another career.
Mm-hmm.
And self-employed is a whole different beast there. So
Totally.
I will completely iterate that, yes, if the sooner you talk to a lender, the better regardless. But if you're self-employed, even the better, because what you talked about with maximizing your tax returns, I learned that in my first business years ago. Oh, cool! Like made no money on tax returns, which is great. But then no one will give me the time of day. But I was like, no, I make money. I was like, no, you make like this amount every year. It's not much. I was like, oh, and it was just eye opening to me.
Mm-hmm.
And that it took a couple of years for me to get things refigured out.
Right. Yeah.
So that's great advice.
Yeah.
So, but if I talk to you sooner and you pull my credit, won't you pulling my credit ruin my chance of getting a loan in 6 months then, or 9 months?
So if it's a financial consultation and we're just reviewing the tax returns, I don't need to pull your credit.
Okay.
A lot of times these sophisticated borrowers, they know what their scores are. They're monitoring their credit. They know what's up. If there's a question and we need to, sometimes we'll even come in on the front end and say, okay, so these are the types of things that you could do to maximize your FICO score even, that's more in the first time home buying market a lot. I think you see that more than you do with, your audience, but we can do that as well. I mean, we're not giving advice. We're actually working with a third party to run their credit analyzers and their algorithms, basically make recommendations, and then we share those recommendations with the client and they choose to execute. But we find that we can really help folks if we get in as early as we can to sort of help them understand the pitfalls.
Great.
Very great. Yeah, it's kind of like a little consultation.
Yeah.
A checkup.
Value to people. That's
Yeah.
kind of where we sort of, it's the same thing. You guys have a consultative process.
Yep.
That's why we get along.
Yeah, I mean, well, that's how you build a relationship, help people out, and then you put the plan in place.
Right.
Because you buy a property today, it's usually months or a year or two of planning before to get things lined up.
Mm-hmm.
So those are all the questions that kind of I jotted down. I think I stole some off your list too, Jenny.
Yeah.
So what other questions do you have?
I don't know. I mean, this is very, very enlightening.
Yeah.
Is there anything that has come out recently that we should be aware of as investors, as loan holders?
Oh, well, there was that, there was a pool for institutional investors, I think, to apply for funds for their tenants who were affected by COVID. They set aside some funds to help those folks. So that might be interesting. I gave you guys a link. Maybe you can put it in the show notes.
Is that for people with
the
federally
CFPB
backed mortgages?
That's all. Well, yeah, that's all.
Okay.
Fannie and Freddie. So it's FHFA. So things like that. Big overarching changes. Well, I mean, we'll see. I mean, it's always fun in the mortgage industry. You never know what's around the corner.
Oh, I know something that we recently encountered. There was post-closing occupancy restrictions. So maybe you could go into that on that one deal that we had where the Fannie had one rule and Freddie had another rule about the rate.
Oh, you have to remind me. Which one was that?
They had a post-closing occupancy for 2 months.
Right.
Yeah.
Yes. I don't remember exactly the deal, though. I know that we had to... What did we have to do with that one? It was just recently.
Mm-hmm.
Yeah, I can't remember.
Okay. But always changing.
Yeah.
Yeah.
Always. Always changing. So I'm going to have to think about that one.
Don't worry. Once we hit stop, it'll come back.
Yeah.
Okay, right? That's the way it works. No, Bill, this has been great. It's great to meet you in person here. Obviously, you're a wealth of information, and you took our curveballs with stride. You're really knowledgeable, much more knowledgeable than the average LO out there. So thank you. What's a good way for people to get a hold of you?
Well, I mean, my website, it's www.rodriguezhouseloans.com. Pretty easy to remember. My phone number is 303-877-6323. My email, brodriguez@houseloan.com. That's no S on that one. And then we are on Facebook. You can reach out to me, DM me there.
Okay.
So we can follow up with some of that information.
And of course, we'll put all these in the show notes as well.
Cool.
I'm assuming you're more than happy people want to talk to you, call you, email you, whatever. Just
Yeah,
get in touch and you'll.
Yeah, and we love the strategy piece. That consultation piece there's no obligation. It really is just about helping people understand what they can do and answering questions. I mean, obviously, we hope to earn the trust to do the business.
Yeah, your whole team is so knowledgeable, so responsive. So I think that it puts a lot of fears and hesitations that people might have surrounding. It's a big thing to take out a loan for a couple $100,000. So
sure.
Yeah, I think that having someone on your side is very helpful.
Awesome.
All right.
Appreciate
Well,
it.
Bill the lender. Thank you.
Thank you guys. Appreciate you having me on the show.
All right. And when you guys have questions, reach out to us. Obviously, reach out to Bill. We're here to help you out. We love doing it. So have a great one, everyone.